Okay, so you think Burger King is just the losing team in the burger war? McDonald's has more locations, more customers, more money, more everything, and Burger King has been stuck in second place for so long that second place basically feels like its permanent job title. You walk past one on the street and you barely even register it. It's just there, like a fire hydrant. Familiar, unremarkable, apparently pointless. Here's what you're missing. Burger King has been losing the burger war for 70 years, and still pulling in billions of dollars. It has gone bankrupt, been sold 5 times, gutted its own headquarters, and handed almost every one of its restaurants over to people who don't work for it. And yet, right now, at this exact moment, the parent company that owns Burger King controls one of the most profitable fast food financial machines on the planet. So the question isn't why Burger King keeps losing. The question is how a company can lose almost every visible contest: store count, sales per location, digital engagement, brand preference, and still be worth tens of billions of dollars. To understand that, you need to go back to the moment Burger King made one decision that quietly changed fast food economics forever. It's the mid-1950s. America has just built itself a highway system, handed half the country a car, and relocated millions of families to suburbs that didn't exist 10 years earlier. People are eating in their vehicles. Fast food isn't just a trend, it's a structural consequence of how the country physically reorganized itself. Burger King traces its origins to 1953 when 2 men named Keith Kramer and Matthew Burns opened a place called Insta Burger King in Jacksonville, Florida. Their core innovation was a piece of equipment called the Instabroiler, a machine that cooked patties fast over intense heating elements. When their venture ran into money trouble, 2 Miami-based franchisees named David Edgerton and James McLemore bought the whole operation, cleaned it up, shortened the name, and by 1959, Burger King was a going concern. There was just one problem: McDonald's. Ray Kroc had already been on the move for years. His model was clinical: standardize everything, minimize variables, turn each location into a human assembly line that runs the same way whether you're in Omaha or Orlando. McDonald's competed on pure operational efficiency: identical menus, fixed products, extreme throughput. And it was working. Edgerton and McLemore looked at that machine and made an honest assessment. They could not beat it on its own terms. Trying to out-efficiency McDonald's, when McDonald's had already built the cost leadership playbook, would just consolidate McDonald's advantage. You don't win a foot race by running the exact same race as someone who's already winning. Burger King couldn't beat McDonald's by copying it, so it had to invent a different game entirely. In 1957, Burger King introduced the Whopper. This wasn't just a bigger burger, it was an economic declaration. The Whopper was explicitly designed to be incompatible with McDonald's identity. Larger patty, open flame broiling, a preparation process that McDonald's couldn't replicate without overhauling every single kitchen in its entire system. McDonald's used flat-top griddles that fried meat in its own fat. Fast, cheap, consistent. Flame broiling used gas burners to sear meat directly and produce a smoky flavor profile that required a fundamentally different piece of equipment. Switching would cost McDonald's hundreds of millions of dollars and years of operational disruption. Burger King had found a wedge. Not the biggest wedge, but a real one. Then, in 1974, they widened it. Burger King launched a campaign built around 4 words: have it your way. McDonald's operational model depended on pre-batching burgers in bulk under heat lamps. It was the only way to maintain that legendary ticket time. A customer asking for no pickles wasn't just an inconvenience. It was a disruption to the entire production sequence. Burger King built its kitchens to assemble to order. It was a deliberate sacrifice of minor operational speed in exchange for a brand promise McDonald's literally could not make. You get exactly what you want. Now, here's the microeconomic point hiding underneath this story. Perception often matters more than product reality in consumer decision-making. Burger King didn't necessarily have a better burger in some objective, measurable sense. What it had was a story: premium, personalized, distinct, that a segment of consumers found more compelling than McDonald's story of maximum efficiency. That story became the brand equity. And brand equity is a balance sheet asset, but a better burger and a better brand story still weren't enough, because Burger King had a much more dangerous problem hidden inside its own business model. Running restaurants is an expensive and miserable way to make money. Think about what it actually costs to own and operate a fast food location. You need the land or the lease. You need a building that meets the brand's exact specifications: layout, signage, equipment, every detail. You need to buy the equipment, train the staff, manage the inventory, absorb the swings in commodity prices, negotiate local labor markets, deal with local health codes. And then you need to do all of this simultaneously across hundreds of locations if you want to actually scale. Burger King's answer to this problem was to stop doing most of it itself. The franchise model works like this. A third-party operator, the franchisee, pays Burger King for the right to put the crown on a building and sell Whoppers. That upfront franchise fee goes directly to corporate. Then every single month, whether that location has a great month or a terrible one, the franchisee hands over a royalty, typically 4 to 5% of total gross sales. Not profits, sales. The royalty comes off the top before anyone calculates whether the store made money. Then there's the advertising fund contribution, another 4 to 5% of gross sales, pooled centrally so corporate can run national campaigns with the franchisee's money. This structure turns Burger King's corporate entity into something that looks much less like a restaurant company and much more like an intellectual property licensor that collects rent. It doesn't need to build stores. It doesn't need to hire burger flippers. It doesn't need to absorb a bad month when beef prices spike. The franchisee absorbs all of that. Corporate just collects its percentage every month, rain or shine. The beauty of this model, from the franchisor's perspective, is the near total separation between corporate revenue and store-level risk. Burger King can expand globally with relatively little corporate capital. The franchisee funds the construction, the equipment, the staff, the inventory, and assumes the operating liability. Corporate Burger King collects its cut from the moment the door opens, but there's a trap door underneath this beautiful structure. And it swings open when the franchisees start breaking. Between 2023 and 2025, a series of major Burger King franchise operators filed for bankruptcy. Meridian Restaurants Unlimited, which ran over 100 locations, collapsed under over-leveraged expansion debt and could not fund required store remodels. Consolidated Burger Holdings, operating 66 locations, watched its revenue fall $12.5 million in a single year, while net losses doubled, crushed by food and labor inflation that had risen over 30% since 2019. And Carrols Restaurant Group, the single largest Burger King franchisee in the United States, operating 1,022 locations, had to be acquired outright by the parent company for approximately $1 billion just to prevent the entire domestic portfolio from deteriorating further. When franchisees collapse, the asset-light model stops being light. Corporate suddenly has to reach into its own balance sheet, step in, restructure, and take on the very liabilities it designed the franchise model to avoid. Here is the ownership timeline of Burger King, and it should give you pause. 1967. Pillsbury acquires Burger King for $18 million. 1989, British conglomerate Grand Metropolitan buys Pillsbury. 1997, Grand Metropolitan merges with Guinness to form Diageo, which immediately loses interest in a fast food chain because its liquor portfolio is more profitable. 2002, Diageo sells Burger King for $1.5 billion to a private equity consortium, TPG Capital, Bain Capital, Goldman Sachs, who take it public in 2006. 2010. Brazilian private equity firm 3G Capital executes a leveraged buyout at $3.26 billion, valuing the company including debt at $4 billion. 2014, 3G merges Burger King with Tim Hortons in a $12.5 billion transaction, creating Restaurant Brands International, 5 major ownership changes in 5 decades. For any other brand, this would be the story of a company in perpetual crisis. For Burger King, it's something different. It's the story of a brand that financial investors kept buying, not because they thought it could beat McDonald's, but because they recognized something the public kept missing. In 2010, when 3G Capital looked at Burger King, the stock was trading at roughly 8.5 times forward earnings, a significant discount to McDonald's at 11 to 12 times, and Yum! Brands at 12 to 13 times. The reason for the discount was real. Corporate overhead was bloated, headquarters had around 800 employees, and the company still directly owned over 1,300 stores, exposing it to all the operating risk it had spent decades trying to offload. To 3G, that wasn't a crisis. That was an arbitrage opportunity. Buy the discounted asset, strip the overhead, sell the store to franchisees, and then re-rate the business as a pure royalty platform, which the market would value at a much higher multiple. That's where Burger King's business became less about burgers and more about finance. 3G Capital's first move after the 2010 acquisition was to implement something called zero-based budgeting. And if you've never heard of it, the name tells you almost everything you need to know. In a conventional corporate budget cycle, last year's spending is the starting point. You get your department's existing budget, add a few percent for growth, subtract a few percent for efficiency, and the process is relatively painless. Under zero-based budgeting, that's gone. Every single line item, every salary, every travel expense, every corporate perk, every subscription, every pencil has to justify its existence from scratch at the start of each fiscal year. Nothing is assumed. Nothing carries over. If you can't prove why it needs to exist, it gets cut. Burger King's Miami headquarters went from approximately 800 employees to fewer than 300 within months of the acquisition. Executive perks disappeared. The corporate office stopped feeling like a corporate office. And simultaneously, 3G moved to sell off those 1,300 company-owned restaurants as fast as possible, converting them to franchisee-operated units and collecting the cash. By the time 3G merged Burger King with Tim Hortons to form Restaurant Brands International in 2014, and later added Popeye's Louisiana Kitchen in 2017 and Firehouse Subs in 2021, the financial logic had compounded. Now you had one corporate overhead structure, one set of procurement contracts, one leadership team, one legal department, serving 4 global brands, generating $47 billion in system-wide sales across 33,000 locations. Corporate general and administrative costs fell to approximately 5% of total system-wide sales, a number that would be nearly impossible to achieve with a single brand operating at Burger King's volume alone. Reducing tiny operational costs across thousands of stores creates billions in savings at the holding company level. Shave 1% off supply costs for beef, poultry, packaging, and potatoes across 33,000 locations, and you've generated hundreds of millions of dollars that didn't exist before. That's the mathematics of scale, and it's invisible from the street. If this breakdown is giving you a new way of looking at how these businesses actually work, hit subscribe and drop a like. There's a lot more where this is coming from. McDonald's outspends Burger King on advertising by a ratio that typically doubles or triples the competition. If you're Burger King's CMO and you're staring at that budget gap, you have 2 options. You can keep running conventional television ads and watch McDonald's simply outpublish you into irrelevance. Or you can stop competing on volume and start competing on attention. Burger King chose the second option and turned the asymmetry itself into the strategy. In 2018, Burger King launched a campaign called the Whopper Detour. The mechanic was simple and vicious. The Burger King mobile app was updated to offer any user a Whopper for 1 cent. But only if they placed the order while physically standing within 600 feet of a McDonald's location. The campaign used geofencing to turn every single one of McDonald's 14,000 American stores into a Burger King order trigger. Within 9 days, the app had been downloaded over 1.5 million times and reached the #1 spot on the Apple App Store. McDonald's 14,000 locations had just been conscripted into Burger King's marketing campaign without their consent. In 2020, Burger King published time-lapse footage of a Whopper decomposing over 34 days. The entire point was to show what happens when you remove artificial preservatives from the product. The burger actually rots, visibly and dramatically, in a way that a heavily preserved competitor's burger does not. Fast food advertising convention says you never show your product looking bad. Burger King published a rotting sandwich on purpose and generated global earned media coverage that a conventional ad budget couldn't have bought. Attention is an economic asset. Every impression that a brand generates through news coverage, social media sharing, and public debate costs essentially nothing compared to paid television time. Burger King repeatedly found ways to make McDonald's locations, McDonald's social media, and McDonald's existence itself into the raw material for Burger King's own brand storytelling. It is one of the most cost-efficient marketing strategies in modern fast food. But getting customers into the restaurant is only half the battle. Here is something Burger King's financial analysts understand that most customers don't. The Whopper is not where the money is. The Whopper is a traffic driver. It's the reason you decide to pull into the parking lot instead of driving past. But beef is an expensive, volatile commodity. Over recent operating cycles, raw beef prices have jumped by more than 13.9%. A cost shock that compresses every margin on every beef-based product across every store in the system. Simultaneously, with essentially no warning. French fries, on the other hand, cost pennies to produce. Potatoes, frying oil, salt. The gross margin on a serving of fries routinely reaches 75 to 80%. For every dollar of fries you sell, somewhere between 75 and 80 cents is left after you account for the food cost. Fountain drinks are even more extreme. Post-mix soda is carbonated water combined with flavored syrup concentrate. The raw input cost per serving is almost negligibly low. Gross margins on fountain drinks exceed 85 to 90%. That large Coke you just ordered for $2.49 cost the restaurant somewhere in the range of 25 to 40 cents to produce. Now look at the combo meal with fresh eyes. A Whopper, medium fries, and a medium drink bundled together at a slight discount versus the individual prices. You think you're getting a deal. You are slightly on the burger. But Burger King has just guaranteed that your order includes both a high-margin side and an extremely high-margin beverage. The bundle isn't a discount. It's a margin optimization tool disguised as a discount The kiosks push this further. Automated ordering screens prompt every customer to upsize their drink, add a dessert, or double their patty with a single tap. There's no cashier to feel awkward saying no to. The upsell is frictionless. Average transaction sizes go up. Labor stays the same. Math improves without any additional customer acquisition cost. The burger gets you in the door. The drink pays the rent. Burger King's American business has a fundamental problem. The American fast food market is saturated. There are only so many corners left. Consumer preferences shift faster than menus do. And every major competitor, McDonald's, Wendy's, Chick-fil-A, 100 regional chains, is fighting over a largely fixed pool of occasions. International markets are a different equation entirely. In recent operating cycles, Burger King's international segment delivered comparable sales growth of 4.9%, and in select quarters, 6.1%. That's not a brand struggling on the margins. That's a brand finding genuine expansion velocity in markets where the middle class is still growing, where the drive-through concept is still a novelty, where Burger King isn't the tired second-place brand but the exciting American import. The vehicle for this expansion is the master franchise joint venture model. Corporate Burger King doesn't build stores in France or Brazil or India. It finds a powerful local partner, a regional private equity group, an institutional investor, a seasoned local operator, and grants that partner exclusive rights to master franchise the Burger King brand within a defined territory. The local partner funds the construction. The local partner manages the supply chain. The local partner deals with the government regulations and the local labor market. Corporate Burger King retains an equity stake and collects royalties on every dollar of sales. Without spending its own capital, France is the cleanest case study. Burger King had essentially no presence in France during the late 2000s. Through a strategic master franchise relationship, the brand acquired a local competitor called Quick, converted the units, and built France into one of its most profitable European markets. In India, the beef menu was restructured entirely, replaced with chicken, mutton, and vegetarian options including the Paneer King and the Veggie Whopper, to honor dietary norms that govern a significant portion of the consumer base. In Brazil, a joint venture with local investment group Vinci Partners scaled the brand across South America. Each of these is a different country, a different culture, a different competitive landscape, and in each case, Burger King's corporate exposure was managed through a structure that outsourced capital, outsourced risk, and retained the royalty. Between 2019 and 2024, cumulative food and labor costs across the quick service restaurant industry rose by more than 30%. That's not a bad year. That's a structural repricing of the core inputs that the entire industry runs on. For corporate Burger King, this is manageable. Royalties still come in as a percentage of top-line sales. If the franchisee raises menu price to offset the cost inflation, the royalty on a higher-priced Whopper is slightly larger than the royalty on a cheaper one. For the franchisee sitting on a single location with a lease, a loan, a crew of employees, and a monthly royalty bill, it's a different story. Margins that were thin in a normal year become dangerously thin in an inflationary one. This is exactly the dynamic that pushed franchisees like Consolidated Burger Holdings into bankruptcy. Revenue fell $12.5 million, net operating losses doubled, and the cost of food and labor had climbed so far above 2019 levels that no combination of price increases could compensate fast enough. Delivery apps compound the problem. DoorDash and Uber Eats have shifted a meaningful portion of consumer ordering off the drive-thru lane and onto the phone. That sounds like opportunity. It's actually a margin drain. These platforms charge commission fees between 15 and 20% of the order value. For a restaurant already running on single-digit net margins at the store level, surrendering 15 to 20% of every delivery order to a platform is somewhere between painful and catastrophic. And then there's the digital gap. McDonald's has 210 million active loyalty members, generating over $37 billion in annual digital sales. Burger King's digital sales penetration sits somewhere between 30 and 35%, better than it was, but nowhere near McDonald's scale. In a world where the most profitable customers are the ones you can target, re-engage, and reward through an app, that gap matters. 3G Capital and RBI's answer to all of this is a plan called Reclaim the Flame. In 2022, RBI committed an initial $400 million corporate investment to boost the advertising fund, co-invest in restaurant remodels, and upgrade kitchen technology across the system. In 2024, RBI acquired Carrols Restaurant Group, those 1,022 underperforming U.S. locations, for approximately $1 billion, then committed another $500 million to accelerate store renovations, pushing the annual remodel pace from 45 stores to 120. The target is to get over 85% of the domestic store footprint modernized by 2028, with digital kiosks, dual-lane drive-thrus, and integrated mobile ordering in every location. This is a company that spent a decade stripping out capital investment and now has to inject it back in to stay relevant. The irony of that cycle is not lost on the people managing it. Now we can bring it all the way together. Burger King is not in the burger business. This sounds like the kind of thing people say about companies to sound smart, but in this case it is structurally and financially precise. Here is what Burger King's corporate entity actually does. It licenses a brand name and a set of operating standards to third-party operators around the world. It collects a percentage of every dollar those operators sell, whether they're profitable or not. It funds national advertising campaigns using money it collected from those same operators. In select markets, it controls the real estate underneath the stores and charges the operators rent. And it does all of this across roughly 19,500 locations globally, with a corporate headcount that would barely fill a mid-sized office building. The 5 pillars of how this machine actually generates value are these. First, franchise economics. Offloading store construction, real estate, wage management, and commodity risk onto franchisees, while retaining top-line royalties, insulates corporate profitability from the volatility that destroys store-level operators. When beef prices spike 20%, Burger King Corporate's revenue barely moves. The franchisee's margin does. Second, brand and marketing. Viral earned media campaigns, the Whopper Detour, the Moldy Whopper, the relentless social media trolling of McDonald's, generate global cultural relevance at a fraction of what conventional advertising would cost. Attention is a resource. Burger King figured out how to mine it from its competitors' own real estate. Third, financial engineering. Zero-based budgeting, accelerated refranchising, and multi-brand overhead consolidation under RBI transformed a bloated, operationally inefficient company into a lean royalty platform with corporate G&A costs running at approximately 5% of system-wide sales. The savings from consolidating 4 brands under one holding company are substantial enough to change the unit economics of the entire enterprise. Fourth, global scale through capital-light expansion. The master franchise joint venture model lets Burger King plant its flag in France, India, Brazil, and dozens of other markets without the corporate balance sheet absorbing the construction cost. Local partners build it. Corporate collects the royalty. It is, in the most literal financial sense, money for something very close to nothing. Fifth, menu engineering at the store level. The burger drives traffic. The drink and the fries generate the margin. Every automated kiosk, every combo meal bundle, every upsell prompt is a carefully designed instrument for converting customer attention into maximum revenue per transaction. Put all 5 pillars together and what you have is not a restaurant company. What you have is a royalty collection business wrapped around a global brand that happens to sell burgers as the bait. Let's run the math on what this actually means for someone on the ground, a franchisee who just signed their agreement and is about to open their location. The optimistic scenario, your location opens in a moderately busy suburban corridor. First-year gross sales hit $2.1 million, below the industry average for McDonald's, but in line with what Burger King's domestic locations have historically achieved. You hand over 5% in royalties, $105,000. Another 4.5% goes to the advertising fund, $94,500. Combined, almost $200,000 leaves before you've paid a single food vendor or a single employee. Food costs run somewhere around 30% of sales, $630,000. Labor at another 30%, $630,000. Rent, utilities, insurance, maintenance, call it $300,000. Your net operating income in a good year is somewhere in the range of $140,000 to $160,000. You invested between $1 million and $2.3 million to get here. At $150,000 of annual net income, your payback period is somewhere between 7 and 15 years. In a good year, the realistic scenario, beef prices spike. Your food cost jumps from 30% of sales to 36%. A minimum wage increase in your state adds $60,000 to your annual labor line. Sales are flat because a competitor opened 6 months ago on the corner you thought was yours. Your net income doesn't just shrink, it disappears. A bad year with nothing dramatically wrong, just the routine volatility of commodity markets and local competition, can swing your outcome by over $200,000 relative to the optimistic case. $200,000. That's the gap between a good year and a bad year for a single location. The costs are fixed. The royalty is fixed. The rent is fixed. The labor contracts are fixed within a season. The revenue is not. It moves with consumer sentiment, with commodity prices, with whatever competitor decided to open across the street, with whether the economy is good or bad, with whether your store looks modern enough to compete, or dated enough to drive customers to the new location down the road. That asymmetry, fixed costs, variable revenue, is the central economic reality of operating under a franchise like Burger King. Corporate has designed the system so that asymmetry doesn't touch them. It lands entirely on you. Before you go, I put together a detailed business guide covering everything we explored in this video: the franchise economics, the financial architecture, the marketing playbook. You'll find the link in the description below and pinned in the first comment. If this kind of deep dive analysis is what you're looking for, that's where to go next. So the next time you pull into a Burger King drive-thru, understand what you're actually looking at. You're not looking at a restaurant. You're looking at a royalty collection platform operating across 19,500 locations in 100 countries, engineered over 70 years to separate the profitability of the corporate entity from the risk of actually making the food. The person who built your burger absorbed the cost of the beef, the labor, the lease, and the utilities. The company whose name is on the sign collected its percentage before you even pulled up to the window. Burger King isn't really in the burger business. It's in the business of turning a global brand into predictable cash flow. And once you understand that, you stop seeing Burger King as the perennial runner-up. You start seeing it as what it actually is: a machine that spent 7 decades learning how to win without needing to come first. If this video gave you a sharper lens for looking at how these businesses work, please like the video and subscribe to the channel if you haven't already. It genuinely helps more people find this kind of analysis. Thanks for watching.